Hello again. It's Eric and Tim.
Hey,
And we're here to do a little more small plates, this time with something called a production budget. So, Eric, when you think about production, what does that mean to you?
means we already talked about sales,
Yeah.
and so we know how much we want to sell. Now we need to know what we need to make in order to meet those customers' needs.
Oh, okay. So we actually want to deliver what we said we were going to sell to
Yep.
them. Okay. Well, you're an ethical businessman.
I try.
All right, that's good. So we talked about assumptions when it came to the sales budget, and we have one more primary assumption when it comes to our idea of production. And now we get into the world of inventory. How much inventory do we need to help us hit those sales requirements that our customers have? And so, in this case, we've said there's something called an ending inventory requirement of 30%. And so, Eric, what does that mean?
So we want to have 30% of our inventory ready to go for the next period. We want to be
Okay.
able to smooth our production so we don't have any fits and starts.
Okay, so at some end of the month, I want to have some inventory here to meet my sales for the next month.
Mhm.
All right?
Right.
And so the phrasing of this thing is I'm going to need 30% of next month's sales in my ending inventory.
Right.
Okay? So July is going to be affected by August expectations of sales.
Yes.
Okay, so I can determine this 1440 or the amount of ending inventory I need. How?
Take your August sales of
So the
48.
4800.
Yep. Multiply it by 30%.
Okay, so I take that times 30%, and I
Yeah.
got that from up here.
Correct.
Okay, and so I get the 1440. So it's ending inventory for July.
Yes.
But then what else do I need to know?
So on July 31st,
Okay,
that is your ending inventory.
all right.
And at the stroke of midnight
Oh,
on August 1st, it becomes August's beginning inventory.
oh, the haunting of inventory. So now it becomes here.
Yes.
So you've got this triangle, if you will, from ending to beginning. So that's something to remember. That's an important piece of this puzzle. But now the other thing we need to think about, though, is how do I fill out the rest of this table? So let's move forward and look at that and see how we go from there. Because all of a sudden, I've dropped in here these two numbers, and the question is, where the heck did you get those two? So let's talk about the timing again, because that seemed to be a big deal when you were talking about it, that we've got these kind of artificial months
Yeah.
in place. And so if I'm trying to get this number,
Hmm.
this 1800, this beginning inventory, previously, when I was looking at July, I went like this.
Right.
So how do I get to this 1800? Because I don't apparently have a June, or do I?
You do not right now, but de facto, what you could do is, we know that 1400 is your beginning inventory is 30% of the current month's
Oh,
needs.
so you're saying the 6,000 is my current sales expectations for July.
Right.
So this 1800 is going to be 30%
Yes.
of the current month,
Great.
because for July, the ending inventory requirement over here in June is that 30%, and it will come back in as the beginning inventory, just like you said, on midnight, August 1st.
Yes.
Okay?
Now you want to do this in a pinch. The math will always work, but don't get confused as to which is the beginning and which is the ending in the requirement.
Okay, because that's a key thing. So when you let's take it back to our inventory equation, because sometimes for folks that's a little clearer than just a table like this. So what's the inventory equation again?
All right, what we start with, which is usually called
Start.
beginning inventory,
Or beginning inventory
plus what we acquire
plus
or what we add,
additions.
minus
minus
what we end with, our ending inventory,
my ending inventory
equals what we use,
equal
or what was transferred out.
what we used. Well, in this case, these terms obviously very descriptive, but we also need to link them back to our little table here. And so the beginning inventory, boom.
Yep.
Got it. So in this case, though, what are the additions?
The additions is our production requirements.
Oh, okay. So our additions here is the amount of production we have to create to meet our sales
Because
expectations.
remember, we're adding to our inventory.
Oh, okay. Yep. So we gotta make stuff
Right.
to sell stuff.
Right.
All right. So then ending,
And it
I can kind of see that one. And in this case, what we used.
is what we transferred out in sales.
So this is what
or
we
what we
sold.
expect to.
So this is what we used
Yep.
or sold.
Yep.
Okay. So perfect. So then when we think about how did we get this 5640, I've got the beginning of 1800.
Mm-hmm.
I'm going to add the additions of 5640.
Mm-hmm.
I'll subtract my ending inventory, which was 1440. And that's going to give me my 6,000.
Yep.
Okay. Now another way that I kind of think about it, just because I tend to be a little bit more of a spreadsheet person, perhaps, instead of a formula person, I tend to say that these two things are always equal to these two things. So if I know that I need 6,000 to sell, and I know I have an ending inventory requirement of 1440, how do I meet that those requirements? Well, I have 1,800 units to begin with, and they'll cover only a portion of this, so I have to make another 5,640 to meet the expectations. And so once you kind of know that layout, you can just copy that all the way over. And from our standpoint, if you can do it once,
Yeah.
you can do it twice. And the only reason to make you do it 6 times is if you had an Excel spreadsheet.
Right.
Anything else?
No, just the relationships. Understanding the relationships. Don't get fixated on the structure of the format. Just understand the relationships and you're golden.
There you go. You heard it from the man himself. You're golden. See you later.
Bye.